Atos, the French IT services giant, is in deep trouble. The company's stock price plummeted on December 6, 2024. It was a bloodbath. Investors ran for the exits, leaving a trail of destruction in their wake. The stock closed at €0.0026, a staggering 98.54% drop from the previous day. How did this happen? What went wrong? Atos has been struggling for some time. The company has been hit by a perfect storm of problems, including intense competition, a challenging macroeconomic environment, and a series of self-inflicted wounds. Investors have been growing increasingly concerned about the company's future. The recent stock price collapse is a sign that they have lost all confidence. The situation is dire. Atos is now facing an existential crisis. The company needs to take drastic action to turn things around. If it doesn't, it could be headed for bankruptcy. This is a story about hubris, mismanagement, and the dangers of ignoring warning signs. The numbers tell a grim story. On December 6th, Atos stock opened at €0.0026. It briefly rallied, reaching a high of €0.0031 before resuming its downward spiral. By the end of the day, over 6 billion shares had changed hands. The stock's market capitalization had been reduced to a mere €0 million. These figures paint a picture of panic and despair. Investors were dumping their shares at any price, desperate to escape the carnage. The sheer volume of trading is a testament to the scale of the sell-off. Atos, once a blue-chip stock, had become a penny stock. The company's estimated 2024 PE ratio stood at a staggering 241.14. This number, usually an indicator of value, was meaningless in the face of such a precipitous decline. The last dividend, paid out in May 2023, now seemed like a distant memory. Atos's management has announced a financial restructuring plan. Details are scarce, but it involves selling off assets and cutting costs. The goal is to reduce debt and improve profitability. However, such measures are often too little, too late. Investors remain skeptical. Adding to the uncertainty is the specter of share dilution. Rumors are swirling that Atos may be forced to issue new shares to raise capital. This would further dilute the value of existing shares, sending the stock price even lower. Investors are trapped, caught between a rock and a hard place. Ironically, amidst this financial wreckage, Atos boasts a low ESG risk score of 12.6 out of 100. Its CO2 emissions per million euros of revenue are a relatively modest 13.5 tons. These factors, however, are unlikely to provide much solace to investors who have seen their portfolios decimated. The Atos debacle is a cautionary tale for investors. It highlights the importance of thorough due diligence, risk management, and the dangers of blindly following the herd. When a company's fundamentals deteriorate, no amount of greenwashing can hide the truth forever.